Hi everyone and welcome back to my channel. Thank you so much for stopping by again. Today we are going to be talking about what not to do before buying a home. A lot of people don't know that there's some things that you shouldn't really be doing because they could affect your mortgage pre-approval at the time when it's time for you to get a mortgage. So today we're going to be talking quickly about some of these things. Before we get right into the video, please don't forget to like, share, and subscribe to my channel for more contents like this. And yeah, let's get right into it. So the first thing that I would say that you shouldn't do before buying a house is to don't miss a loan payment. So this basically covers, your credit card loans, your car loans as well. Don't miss a payment because all these things reflect in your credit report. So when your lender is reviewing your documents and doing the check, if they see that you're missing payments, then that's not going to instill confidence in them. Especially when they're going to be loaning you a huge amount of money. They want to know that you're able to pay on time, you're not missing payments, and all of that stuff, right? The next thing that I would say is to not apply for another line of credit right before buying a place, because you're pretty much incurring more debts, right? So you don't want your debt ratio to be too high, higher than your income ratio as well. All these different things add up. So it's very and it could also be a red flag to a lender if they see that you have a huge debt ratio. You're lending and borrowing money and getting credit cards upon credit cards upon credit cards. It could raise a red flag to them, and you don't want that at the same time, right? So that's something to be aware of as well. When it comes to buying a property, if you're close to buying a property or if you're looking forward to buying one, it is advisable to not get a car right before buying and right before getting your mortgage. And the reason is because a car is a huge expense. It's not something that it's something that would show and would reflect on your report. So when you're getting another loan that is something like a car loan, that is pretty much cutting into and increasing your debt ratio as well. So that's something to be aware of, right? Another reason why you shouldn't get a car just before getting your mortgage is because when you get pre-approved, you're getting pre-approved based on your current financial status, right? Your current financial basically your current financial status, right? So when you're getting pre-approved, if you go and get a car right before getting your mortgage, you already got pre-approved before, and they already gave you a pre-approval based off of your financial stability at that point, right? Based off of the debts that you had then, the income that you had then, the down payment that you had then. But now if you're going to be adding a car right before you get your mortgage, you might not get pre-approved for the same amount that you got pre-approved for before. So in order to avoid all of that default and end up losing your property if you already even put in an offer, it's very important for you to not incur more debts before you close on your property. Right after you close, you can definitely do that, because I know some people like to improve maybe their standard of living. Maybe they're moving out of the city, right, and there's not a lot of transportation around there. Then they want to get a car to move around easily. But it is very important to wait until you're able to close on your property, so that way everything is settled and finalized on that end before you now go ahead and get another loan, right? Another thing that I would say is that you should not move your finances around. A lot of people, because they want to improve their chances, they would move money from one account to another, but the thing is that when it comes to getting your mortgage, when you're putting your down payments, the down payment has to have been in your account, in one account for minimum of 90 days. The lenders normally look at having that money in a stable place, because that gives them assurance that you have that money is actually there. It's not like there are no red flags when the money has been sitting in your account for a couple of months, right? Compared to you just moving things around. And some people think it might help your chances, but at the same time, lenders can see that as, you're not stable, like your finances are not stable. And if they feel like your finances are not stable, then they, what would what would basically give them that surety that, that assurance that, you know, you are going to actually, you know, end up paying for the last thing that I would say is that when you're looking to buy a place, don't be switching jobs last minute, right? If you had to switch jobs, you know, but it's in the same field, you know, it's easier for you to explain that compared to like switching jobs, like switching different fields. And when it comes to getting your mortgage, you know, the lender wants to see that you're stable. They want to have that sense of assurance that, okay, this person has a stable income, this person has a stable job. You know, the moment they start to see fluctuations here and there, it could arouse like suspicions as well, right? Or, you know, just because, you know, what if the pay is different as well? Maybe it's less than what you were getting paid before. That's something that, you know, would cause a red flag. That would be a red flag to them, right? So you need to be able to have, they want to make sure that, okay, this person at least would have enough to sustain their mortgage. This person will be able to pay their mortgage on time. You know, if they see that you're fluctuating jobs and like switching jobs anyhow, they could think about that as, you know, what's to stop this person from, what if this person loses their job in the middle of, you know, paying their mortgage and they're not able to cover it anymore? Then that's an issue for the lender, right? So it's very, very important for you to ensure that you're not switching jobs and not doing things last minute. Don't incur debts last minute. You know, ensure that you're well planned and, you know, you have excuse me please, ensure that you have all your finances in order. You know, your basically everything that you need to get your property ready, your mortgage, pre-approval, your down payments, have everything in order, right? So yes, thank you so much for tuning in today. That's all that I have for you today. If you have any questions, any concerns at all, if you have any questions related to real estate, don't forget to reach out to me, call me and text me, and I'll be sure to answer you. Thank you again, and don't forget to like, share, and subscribe, and I'll see you in my next video. Bye.